Today, we're going to tackle a huge idea, a core principle of modern finance. We're talking about risk, but not the way you've probably heard about it. We're going to look at it through the eyes of the world's greatest investors, and it might just change how you think about building wealth forever.
So let's just start with a really provocative question. What if everything you've been taught about investment risk is just plain wrong? What if the yardstick that Wall Street uses to measure danger is actually pointing you in completely the wrong direction? That's the big idea we're diving into today.
All right, so first things first. To really understand the alternative, you have to get a handle on the mainstream view. Let's take a look at how academic finance and, Wall Street have traditionally defined and measured risk for decades.
And here it is, the big showdown. On one side, you've got modern portfolio theory. This is the bedrock of pretty much all financial advice, and it says risk is volatility. The more a stock's price jumps around, the riskier it is. The goal is just to smooth out the ride. But then, on the other side, you have legends like Warren Buffett and Charlie Munger, who basically say that's nonsense. For them, the only risk that matters is the permanent loss of your capital. Paying $1 for something that's only worth 50 cents, and then watching that dollar vanish for good.
So what exactly is this volatility they're talking about? Well, it's just a fancy word for price swings. How much does the price bounce up and down? And you might ask, why did this become the academic gold standard for risk? Honestly, it's because it's easy to calculate. You can plug it into a formula, build these elegant-looking mathematical models. It gives off this vibe of scientific precision. But as we're about to see, the world's best investors would argue it completely and totally misses the point.
So now, let's flip the coin and look at the other side of this debate. This is the value investors' take, and it argues that we should be afraid of something far more real than just a bumpy ride on the stock market.
Ha! You really can't get any more blunt than that, can you? Charlie Munger, Buffett's brilliant partner, just dismisses the whole academic idea out of hand. And why? Well, because focusing on how much a stock price wiggles day to day is confusing the journey with the destination. Think about it. A truly great business might have a volatile stock for a while a truly terrible one could have a nice, smooth, predictable ride straight into bankruptcy.
This is the absolute heart of the value investing philosophy. A permanent loss of capital is the ultimate final risk. It's not a price dip that you can recover from. It's you making a fundamental misjudgment about what a business is worth, and that leads to a real, irreversible loss of your money. The whole key is being able to tell the difference between a temporary markdown and a permanent breakdown.
And this quote from investor Howard Marks just nails the human side of it. This definition, it just makes common sense, right? I mean, when you're lying awake at night, worried about your savings, are you really scared that a line on a chart is wiggling too much? No, you're scared that your hard-earned money might disappear and never come back. The fear is about the real-world outcome, not the day-to-day noise.
Okay, so if the real risk, the monster under the bed, is a permanent loss, how in the world do you defend against it? Luckily, value investing has a core principle designed for exactly that.
This is one of my all-time favorite analogies from Warren Buffett, because it makes a really big idea so incredibly simple. That extra 20,000 pounds of strength that the bridge has, that is your margin of safety. It's your room for error. It's what protects you if your calculations are a bit off, or if you just get some bad luck. That exact same logic works perfectly when you're buying a piece of a business.
And here's the more formal definition, which comes from the father of value investing himself, Benjamin Graham. Your margin of safety is simply the gap between a business's intrinsic value, what it's actually worth, and the price you pay for it. A huge gap gives you this wonderful cushion against bad luck or your own mistakes. A tiny gap? Well, that means you're walking a tightrope without a net.
Now, the process sounds deceptively simple, but I've got to tell you, simple is not the same as easy. First, you have to do the really hard work of figuring out what a business is truly worth. And step 2 is having the discipline, the patience, to only buy when the market offers you that business at a price that's way, way below your calculation. That discount, that's your protection.
So if all of this is so logical, why isn't everyone doing it? Well, the answer has less to do with math and spreadsheets and a lot more to do with human psychology.
Just think back to the 2008 financial crisis. The market drops almost 40%, and the VIX, which is basically Wall Street's fear gauge, it went completely off the charts. It spiked over 80. And this is where that academic idea of risk becomes a self-fulfilling prophecy. The crazy price swings trigger very real fear, which drives people to sell in a panic, which creates even more volatility. It's a vicious cycle, and it's fueled entirely by our own emotions.
And that cycle is driven by these mental shortcuts that are hardwired into our brains. Things like loss aversion. It means that the pain of losing $100 feels twice as bad as the pleasure of gaining $100. It pushes us to sell at the absolute worst time. Or herd behavior, that feeling of safety in numbers. It makes us feel smart buying when everyone else is buying, usually at the top, and then selling in a panic right alongside them at the bottom. These biases are the kryptonite to logical, value-based investing.
Okay, this brings us to the final and maybe the most crucial shift in your mindset. We are going to completely flip the script on volatility. We're going to reframe it not as a risk you have to avoid, but as an opportunity you should embrace. And this is where it all just clicks into place. If you've done your homework and you have a really good idea of what a business is worth, then market panic, volatility, is the best thing that can possibly happen to you. It's the very force that creates the bargains you've been waiting for. It allows you to buy wonderful companies with that huge margin of safety we were talking about.
When it comes down to it, your knowledge of a company's true value completely transforms volatility from a threat into a tool. When the stock price of a great company suddenly drops for reasons that have nothing to do with its long-term future, that's not risk, that's a sale. You're just getting the chance to buy the exact same great business, but at a much cheaper price.
And this final quote from Buffett just perfectly captures the trade-off. See, the quest for smooth returns, for avoiding volatility at all costs, very often means you have to accept lower long-term results. A value investor is perfectly willing to put up with a bumpy, lumpy ride in the short term because they know it's going to lead to a much better destination in the long run.
And so that leaves us with this one powerful, timeless question, first asked by Benjamin Graham. Is the market your master, or is it your servant? If you let its daily mood swings control your actions, if you buy when it's euphoric and sell when it's panicking, then it is your master. But if you use its volatility, its manic depressive nature, to serve your own long-term goals, then you make it your servant. The choice, ultimately, is yours. Thanks for tuning in.